Hey guys, I'm Adrian Manz, and I'm going to talk today about how to use one of my signature trading strategies, the volatility bands, and incorporate something that we incorporate every day in our war room with our guys. We talk about Fibonacci projections, Fibonacci extensions, reversals, and how these things fit into big picture confluence when it comes to trading the markets. I'm going to use one specific stock because we trade it quite a bit, and that's Tesla. You can trade it directly with Tesla this way, or you can trade like TSLL, the $12 version, the two times levered version of Tesla. It amplifies all the moves by two. Or you can trade the stock directly. So I trade the stock directly, and you're going to see this is something that I make quite a bit of use of. And I think that when you go back and just go and see how we apply this stuff and see how our guys are applying this, that, what you're going to come around to is the Fibonacci stuff really fits well into this type of trading. We go and we try every day to anticipate where the programs, the algorithm, the artificial intelligence, where all this stuff is going to go and come into play in the markets. And because the things that we look at on an intraday chart are the things that these programs very often key off of, as we can overlap them and find confluence in what we're doing, our trading projections just get stronger and stronger and stronger. And, I think you'll see here how we're able to make use of all these things and really do a good job of predicting where price is going to go. So I'm going to take you through the idea, the structure, how do I put these plans together, how do I figure out what I'm going to do, and then what I did was I recorded the live trades from our war room from yesterday and the day before yesterday, so from Tuesday, when Chairman Powell was going to speak, and from Wednesday, the day after. So I had the Tesla plans that we had put together, and I was trading those live in the room with the guys. And I went ahead and recorded the whole session. I'm going to go and just truncate those down to the periods in time that we had something happen with the fib and with the entries and exits and such. But you'll see exactly how these things come together and how they work in your favor when you get used to looking for confluence of indication. And don't just go, hopping into something because of momentum or because of one particular indicator. So let's go ahead and get started and take a look at what I'm talking about here. Let me first tell you that, I've been around, and Julie, my wife, have been around for a long time. We are trading partners. We started trading together in graduate school, and we spent a lot of time developing theories of how trading works. So we took data that we were able to collect from the New York Stock Exchange. We built models about stock trading that we thought made sense. We spent a lot of time at the NYSE, as you can see there, especially in our earlier years in trading. Haven't been there in probably 2 or 3 years now, but we'll get back down there again. We love it there. We love the people there. And we were able to make very, very good use of that data in building our models. Our models led to a lot of publications that we've done over the years. We have MBAs and PhDs. MBA in International Business and Finance, PhD is in organizational behavior, and specifically our focus is on behavioral finance. So we're psychologists who like to look at how markets behave, how people in markets work with the data that they're given, how they react to the structure of markets, and what their psychology does in terms of giving us predictive validity of the models that we're putting together. I have written a bunch of books. I've been featured in a couple books that are out there. A fellow did a thing called Breakthrough Strategies of Wall Street Traders, and you can see that in the bottom corner there. The other things are articles that I wrote. And, when he profiled me for the Breakthrough Strategies book and talked about, how we handle markets. And it's not very different today than it was back then. And even going all the way back to Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. That was the first book that I wrote. That was the one that was originally called A Multivariate Analysis of Covariance in the United States Equities Markets. That book goes through and isolates what happens in reaction to the psychology of human beings in the markets. So it was originally based on a bunch of statistical models, and then, when we decided to turn it into more of a popular press kind of a book, we went and converted it all to patterns, patterns that people can recognize, and how you can go and just sort of pick apart market behavior by flipping through charts and finding things that are happening. And that's what I'm going to show you today, and focusing your energy on picking up on the footprints of money and what that stuff is going to do to, again, the psychology of all the people who are trading it. Then I've written a bunch of other books, and there's international versions of these books as well. But over the years, I think that it's just been fun to get our ideas out there. I do a lot of public speaking. I really enjoy talking to people, meeting traders. We also started a TV show. I should tell you, our house burned down up in the Palisades fire. And, we're no longer headed up to Hollywood to do a television show, not really entertaining that idea right now, because we're living down in Orange County. We're at our beach house down on Balboa Island, enjoying a place we thought we were going to retire that is now sort of an early place for us to live. We did not expect to be here while we were still working, but we're making do with it, and we are going to do the Trader Nation show online. It's all about the psychology of traders. So this is all about, what drives market behavior, what's different among top traders than among retail traders or top retail traders, even from guys who are just starting out, guys who are struggling. We talk about a deep dive into trader psychology where, what we'd love for people to do is send us, you can send us just a recording from your iPhone or your Android phone, talk about, hey, I've got the following problem with trades and it happens to me all the time. I get out too early, or I let my losers run and I cut my winners short. And how do I get around this stuff? And those kinds of things are the things that we enjoy talking about with people in terms of the Trader Nation stuff. And I think it's just going to be an excellent thing to take and do online, do as a YouTube kind of a show, as opposed to trying to do everything live all the time on a sound stage in a studio. And, the psychology, I can't tell you how important it is. We do an income trading boot camp. It's the income trading boot camp mastermind program, coaching program. And it's a year-long program where, we really get to know the people who attend this thing. And everybody is very, very actively involved. We do the first 60 hours of it is done online. And then we all head down to Miami Beach and do it together as a group. So there's never more than 20 people in that room. And when we're there, it's just really a deep dive into the material that was covered in 750 pages of manual and online training and all the stuff that goes into learning how to think about the markets and how to think about the markets a little bit differently than you probably do. And then go around that room there. And what I can tell you is everybody brings their own psychology to the table. And that's something that, we have to work with, because I'm just looking at the back row there. Guy in the red shirt is a food photographer from Chicago. The guy next to him in the black shirt and the short haircut, he's a cop from Michigan. The guy in front of him owns a limousine service. The guy next to him was a chemical company owner. There's attorneys there. There's guys who own ranches. Biopharm president of a big company that develops biotech stuff. And what they bring to the table is they've all achieved success, and I'm sure you have too, in their own business, in their own way. And you have your baggage of what it is that you expect to do in order to be successful. And a lot of times, the fact that you've achieved success doing one thing actually makes it difficult to achieve success in trading, because trading isn't necessarily so intuitive. It's not something that you build all this intuition with. It's more counterintuitive. You have to go against your thought process frequently. You have to go against what seems logical, against what seems most probable, and work your way out of that line of thinking and into all right, look, here's where the Fibonacci lines are. Here's where the volume weighted average price is. Here's where 2 standard deviations of volatility is. I need to wait for price to come back down to one of those levels. And if it comes back down, I'll take the trade. But I'm not looking to get in on the way down, let's say on a short sale, because that's where I'm looking for it to go. And I think it's going to go there. I'm going to wait patiently for it to get there, because the other thing that I know is it might not. And that's not really the way most people really think about life in general, or about their business. Their business is usually done in this very logical, straightforward, I want to get from point A to point B, and how do I get there? So what we're going to do today is talk through a very structured set of trades. And as I said before, I'm going to focus my energy on these plans that I put together. So everything that I do is put together in a plan the night before. And after the market closes, I put together a trading plan for the next day. And that's what goes out to the guys. And what we work on in the room together then is, how is the plan shaping up? Are things coming into a place that we would assume is going to be a logical jumping point for the trades that we have set up to go and achieve what we would like for them to achieve? We want a profitable outcome. We all want a profitable outcome. Along the way, a lot of psychological hangups that will pin people down. I'm going to give you a link in a little bit here. As I said, we're both psychologists. We developed a big inventory. It's called the Manz Trader Readiness Inventory. Maybe you've heard of it. You can take that for free, and it will score itself for you for free. And you can ask us, hey, could you help me interpret these scores? And we're happy to do that. So when I show you the slide here that has the link on it, go ahead and copy down the link to the Manz Trader Readiness Inventory and take it. And some people say they learned something about themselves. Some people said, oh, I knew these were the things that I was going to be strong on as I was taking the test. And other people will say, I had a suspicion that I had these problems, but I didn't know. And then other people will just come up and tell us, I took that test and man, I feel like I need a hug. So it's something for everyone. And there's no upcharge, no upsell, no nothing involved with it. You take the test, you see how you did, and you'll learn a little bit about yourself. So let's dive in now to the strategy, to the volatility band strategy, because this is really a big part of what we do every day. And I want to show you how it's put together. And then I want to show you how we go and interpret what's been put together today in the context then of what's happening tomorrow. We developed this plan years ago as a spiders, diamonds, and Qs trading plan. It was all about catching the volatility of the indices and then trading the indices according to these plans that we had. We still put that kind of thing together, but it's not really as dynamic of a plan as the one that I'm going to show you here is. This has had shifts through sectors. Right now, it's primarily focused on the Magnificent Seven. In the past, it's been focused on biotech. It's been focused on pharma. That probably wraps up, that's the summary of what it really is focused on. It's always been either biotech stocks, pharmaceutical stocks, or tech stocks. And right now, the subsector of tech that we're looking at primarily is stuff that's in the Magnificent Seven. So it might be internet content, in the case of Google or Meta. It might be consumer discretionary in the case of Tesla. It could be sort of a mix between retail and tech in Amazon. But one way or another, when I'm setting up those trading plans, what I'm trying to do is isolate the potential for profit by looking at where programs are likely to hit the market and cause trading inflections. And the way that we do this is I look at floor trader pivots. That's native to all of your software. Central pivots, just today's high plus lows plus close divided by 3. And that gives you tomorrow's central pivot. And then the first support, second support, first resistance, second resistance are just calculations that are derived from that. Natural support and resistance, this is a matter of going through and drawing lines. You want to capture where do things inflect, where's the highs, the lows, the opens, the closes, where's all that stuff line up over the course of the day. I do a volume by price cluster analysis. So if you're a Realtick user, you can isolate volume by price the way that I'll show it to you here. If you're using anything else, you can do volume profile, you can do a different version of volume by price, doesn't necessarily do a hierarchical cluster analysis on it, but it just gives you volume at each single price of the day. All that stuff's going to work fine. This is all based on just following through and trying to bring all the pieces of data that you can to the table and figuring out how do these things fit together. I also use Fibonacci retracements quite a bit. And then what I don't have on here is 2 SD bands. You can use them, you cannot use them. I think for some people, it's something that clutters the data a little bit. So it could be Bollinger Bands. It could be the version that I use, which is 2SD of Volatility. But one way or another, if you add that, I think it makes for a good data point. If it's too much information, if you start feeling like you're overwhelmed with everything that is getting tossed up on the screen at you, then you just don't use it. So I separate each one of these things onto individual charts. I've got a separate chart for each one of the analyses. I don't like a chart that has a lot splayed all over it. I like a chart that's pretty clean, pretty concise, and gives me a good feel of what that one indicator is doing. So here's how I put this plan together. So this is from September 22nd, 2025, and this would be market closed. And we'd look at what happened over the course of the day. And I can see I've got a trend lower. Tesla did a lot of selling over the course of this session. And now I want to figure out where are the likely selling points tomorrow going to be? Where would the selling likely pick up again if Tesla traded into some of the support and resistance, volume by price clusters? Those are out there on the right axis. You can see them. You see how they're clustered, and there's white spaces. Those white spaces are there not because there was no volume there, but because that volume was less important when it was analyzed in terms of what happened next than the volume that stays on the chart. So right here, let's just draw a fib study. Let's just go trough to peak, peak to trough. And you see here that the move in the market, the major move, that first big move, right there at 435.88, I see there's a 382 retracement and there's a reversal bar. I call that reversal bar an infield fly bar. That's in around the horn, which is all written around a baseball analogy, a baseball metaphor. That little bar, so I don't know if you're trading candlesticks, it's an evening star or whatever. Julie trades candlesticks, I don't. I just like bars. I like looking at data on bars. And you can see that that lines up right with that 382 retracement. That tells me that that is probably going to be an inflection point tomorrow as well. I've got this move lower, this sort of second wave lower, and if I do a fib study on that, what we see is that 435.93 is now a 50% retracement. So depending on what time compression people looked at when they started doing their analysis of where they wanted their programs to hit or where they were going to do their trades themselves, you've got either a 382 retracement of a big major move on a 5-minute chart, or if somebody's using a shorter time compression, they might look at the second wave that I had there, and they might base their trading on that tomorrow. But everything here is in place that says we've got confluence between two different Fibonacci compressions. When we look at the chart again, the next thing that I like to figure out is where is that floor trader pivot going to be tomorrow? So it's the high plus the low plus the close divided by 3. And that says, oh, look at that. In the next day's trading on September 23rd, we're expecting that the 436.06 pivot will be confluent with the Fibonacci retracements that we saw, and will be confluent with the place that we saw this natural support and resistance reverse the market as well. Then I want to go and draw some lines. I want to look at what happened. So down here at 430.15, that's definitely the lowest place that I see that there was support during the session. If I go up a little bit, I see here that 431.88, that nicely contains where price bounced on the way down. So after 12:30, you can see price sort of inflected there, went up, and when price came up to it for about 12:45, 12:50, you saw or it's even 1300 there, right? It came up and it pushed through, and right up above there is where price took off from. And look at the volume by price, you see that it's nicely contained by those two lines as well. So the important stuff happened between those two levels. Now we have another level. This is after the white space on the volume by price, and it does a very good job at 432.80 of saying this is a support level. This is a support level that if it's broken, price is likely going to get down, move down through, and start retesting that 431.88, 430.15, and then finally up here, 434.56, I've got another level. I've got another place where price tried to break above, kept moving down to that lower level, down to 432.80 from up there. And I'm going to take all of these levels and transfer them to, I think you really need to put together a trading plan. I don't think it's a good idea to not go into the session with something that's written, with something that you have right in front of you. If you guys want to do a free trial till it's 2 weeks, there's no credit card, no nothing to our war room, then you'll see this plan every day. You'll also get the NYSE trading plan, but you get the NASDAQ volatility band setups, and you'll see, for instance, on Tesla, everything that we just talked about has been transferred to a trading plan, a gouge sheet that you can just have on your desk. And what you see is it's a short. We're looking for an entry 434.56 down to 432.80. We're looking for a 432.80 down to 431.88. We're looking for 431.88 down to 430.15. And also, don't forget, we were looking at that pivot where we know there was an inflection. Pivot over there is the P in red, 436.06. So all of that's great until you start thinking about the psychology. And the psychology behind being profitable in the markets is very, very dependent on how well you are able to come to the table clean every day. No good days, no bad days, just days. You step up to the plate and you're swinging at the ball, and you're not thinking about the last time that you struck out. You're not thinking about the time you knocked the cover off the ball. The only thing you're thinking about is, I've got a trading plan, and if things go according to the plan that I have, this is the way that I want to handle the trades that are in front of me. Your ability to do that, I told you before, we did an inventory, and this is where you can get it. It's TraderInsight.com/MTRI. If you go there, you'll take it online. It's a type form test. It's going to go through. It's 100 questions, and it's going to go and assess your readiness, your preparedness to trade based on these scales. So there's an emotional intelligence scale. Are you able to, recognize and regulate emotions? Can you stay disciplined when you're in a stressful situation? Cognitive reflection. Do you make deliberation a part of how you think? Are you a logical thinker, or are you impulsive? So if you can plan and make high quality decisions in trading, you're already a step ahead of the game. But if you are very likely to do things based on impulse, I think I see something, my gut's telling me to do something, right? That's part of the cognitive reflection domain, as well as the impulsivity dimension. You need to be able to look back and think through the situation, and also to think ahead of the situation to figure out, is this going to be a good trade, or why did the trade go the way that it did? Your risk profile, this is pretty straightforward. It's your tolerance for financial risk, your tolerance for psychological risk, and are you able to size positions responsibly? So that's a really good I think, risk assessment as to whether or not there's good suitability in the way that you're wired for what you're going to try to trade. Impulsivity is the tendency to act without adequate thought. So high scores on this suggest you've got really good impulse control. Low scores say you might overtrade. So how many people do you know? Or how often have you seen yourself get into a trade because the train had already left the station? You see that the trade is taken off and you don't want it to take off without you. So you go and you jump into it, and now you're in a mess. Now you're in somewhere in the middle of the range, and if it gets back to where you should have got in, you're already at a loss. And if it starts moving against you, your reward to risk ratio is completely upside down. That's impulsivity is going to give you a good feel for how you're wired in terms of that. Emotional stability. This is neuroticism, and this is about how resilient are you when there's losses? How much do you blame yourself or start just coming down on yourself if trades go bad? So take the test. Take a look at it. You're going to like the test in general, I think. And as I said, if you have an issue or you want to discuss something about it, you can always shoot us an email, and we're happy to talk to you about what's going on. So it's Adrian@TraderInsight.com. You can always get a hold of me that way. Now, let's go take a look at the live recordings of how Tesla played out the day after that trading plan was published, and then the next day, and look at how all those indications come together to give you a confluent idea of what's actually happening in the markets. So we shift our ideas from the trading plan to the chart. And what you see here is I've got all the levels drawn: 434.56 down to 432.80. 432.80 down to 431.88, and 431.88 down to 430.15. And what you see happen over the course of the day is Tesla has gone and, it hits these zones, it hits these lines, and these are program trading lines, presumably, and what we're looking to do is just capture the momentum from one zone to the other. Right now, the 434.56 entry is touching the target for the third time today. So we had a move lower back here around the open. That one actually got us in, stopped us out. That was a $1 loss. Then we had a 434.56 entry. That came down to 432.80, went from 432.80 down to 431.88. Continuation move lower. That books two of the bands. And as you can see, it hooked back up through. So you're always just trying to bring your stop in behind the position, bring the stop down to that next band. Got up above 434.56 again, and then made another move lower, both bands. So over the course of the day, really, I like to start on the proper side of the most extreme band. So the high band here, 434.56, we've really had no reason to go and adjust these programs yet. And when I start trading in the morning, I consider these lines to be good for the first hour. I take a break, I go for a walk, we walk around the island, we take the dog for a walk, Julie and I just go out and clear our heads. When we come back, our first job is to assess, are the levels that we established on our trading plan the night before still valid for today, given what's been going on? Now, you can also look for confluence, and you can look for other things that are telling you that price is doing something that makes sense in terms of what's going on. One of the first places I like to look for this is out here on this axis. And I want to see, how does my volume by price line up with these zones that I thought were going to confine the price action for the day? And here you see volume by price overlaps very nicely with what we thought was going to define these high volume trading zones. So that tells us our trading plan, right now anyways, is still on the money. It's still managing to isolate what's happening in terms of price being constrained within certain levels. We can also, though, look for some other things to tell us there's confluence. And one of these is the theme of this presentation or this conference is all these fib levels. So we can take the most extreme fib move of the morning here and say, what does this, it's down to here, I guess. What does this say, this big swing move, what does this say about where we think the market might be going? And the first thing that should capture your eye is 434.74, just right above our stated entry price and exactly where price happened to inflect on the way up the last time is a fib line. If we take the next most significant swing here from this peak to this trough, we got 434.73. So again, things are lining up and saying in different time compressions. If people are looking at this in 1 minute, 5 minute, 10 minute, 60 minute, 30 minute, whatever they're looking at, they're going to see a lot of things in terms of confluence in their time compression. So they're going to see their levels lining up, and they're going to see things like these fib lines lining up. If we go and look at another source of confluence, let's this time pull up our VWAP. Then we're cued into the fact that that big fib level we were looking at also happens to overlap with the volume weighted average price, and then the lines that we drew and the way that the volume by price and everything lines up again tell us, oh, we've got another source of confluence here. There's another reason to think that if we get up and we touch the top of that program range, that we're going to have another bump back down into the bottom of that channel. Now add 2 standard deviations of volatility here in this case. We've got these envelopes drawn, and we see that 2 standard deviations of volatility also puts us right back at that same level. So that 434.56 level overlaps with that 434.75 level, overlaps with that volume weighted average price, overlaps with the volume by price, overlaps with 2 standard deviations, and everything about that level tells me that if I penetrate it from above, so now I'm up above the price, if I come back down through it, there's a better than average probability that I may see a move back down into 432.80 or maybe lower. So now the next thing I'll look for here is a move up to 436.10 for a reversal. So that would be a level that we've identified over the course of today's trading day as overlapping with that central pivot and giving us some natural support back in here and a natural source of resistance from this reversal move yesterday. So let's just see what happens and how this will play out then over the next few minutes. All right, so continuing with our narrative, you can see here that we are coming right down into this profit objective that we talked about earlier. And if you guys were watching from the point that we said if it gets into 434.56 and then add at 435.54 and then actually add again at 436.10, so what we were talking about with the pivot inflection that we were expecting, the 436.10 or 436.09 print never happened, right? So it just got up close to the pivot line. I think it was 436.05. I wasn't sitting in front of this thing at the time, but sometimes that's just the breaks. You miss something. That's okay too. The key is, I think, to stay patient with these things and, just let them trade by whatever your criteria are, whatever your rules are is what you want to focus on. This 432.80 level here is, that's sort of a softer kind of a target. I think this level right here actually might be just fine to close this out and then look for another opportunity. We've got Chairman Powell speaking right now, so that's always a concern, but you can sort of see how the logic there played out. So between the Fibonacci retracements that we talked about a moment ago and the confluence that gave us with the volume weighted average price and the confluence that it gave us with that overhead 2 standard deviation of volatility band, and then also with those zones that we pinpointed out on the right of the chart, where we're looking at where the volume by price stacks were, right? Everything's staying under the pivot line. It, the downside is after we were in the trade, it started looking like the slope was up, but it never violated our stop. And, so right here, it gets you down into that profit zone. So now we'll just look for the next opportunity. As I said, the Federal Reserve Chairman is speaking right now. So we are going to see if we get back up and around and if the market settles down a little bit and we can avoid any big swings here on Fed speak. All right, so here's another example. So we had this move up into an infield fly setup. And infield fly, this is just a textbook around the horn setup. So everybody who's been through the Income Trading Academy, the boot camp, or just about anything that we do, you know this pattern. And I know there's candlestick patterns that look just like that evening star or whatever it is, but in the around the horn kind of a system, this is a definite pattern that we look for in terms of what's going on in the market today. So there's a bunch of things behind what you're looking at, but really you're looking at one of these overextension moves that gets you up into the range like this, and then you get the magic because it happened right at that fib retracement. So you can see the fib line is up top there. That's a 618 retracement. It's right under that pivot line, so that makes it that much better. And, when it comes down and it gets into this area that it's in right here, right now, right? So that was our exit on this trade was right down here, right at these lows where it overlaps with this stuff right here. And you can see it went and it, reversed back up in. As a matter of fact, we had one of our traders took a long in the war room. Right now, it's coming into, it's going to look for that 432.80 target. And right, this all lines up with all this confluence that we were talking about earlier. It's also coming down into a 2SD band. The 2SD band is pointed lower. That would indicate that maybe, just maybe, there's room for a move down into 431.88, which was our next target on it. But if you're trying to get the overlap between the Fibonacci stuff that you guys love and what's going on in the markets, the key to the whole thing is you have to be patient. You have to wait for it to come to you. When it comes to you, you want to see confluence. You want to see an overlap of indications. You want to see a pattern that you know, a pattern that you like. And, when everything happens this way, then you can get something like, what we're looking at right now, where you get this move down. And now we're actually into the next set of bands. So the next set of bands from our trading plan was 431.88 down to 430.15. So this is exactly what I'm talking about when I say I want to see things just overlap and come together. And a fib tool is a great thing to add to your arsenal, but you don't want to make it the only thing that you're looking at. I think when everything is in place like this, it just makes for a much better situation, a much better trade. Now we've had Chairman Powell stop speaking, and he talks about he thinks the market's overvalued, and of course the market went and took off to the downside. And here again, right, where do you anticipate that things are going to happen? So in this case, if we take and do a fib study of the peak to the trough, so we can see there where the market just really came in, then what you see right away is that this area right here is where we're catching an inflection. So that 382 pullback is 428.96. I don't really like to trade these kind of things, and I tell my guys, that this is risky business here just because the market's reacting to geopolitical news. But let's say that you got short that infield fly move and you didn't get out any of it along the way here. Market took off the downside, and now you're looking at, well, where do I think things are going to happen? So, like I said, I think inflection at 428.96 is in the cards, and anything that breaks through 430.29 is probably going to start seeing the retracement back up into the higher part of the range. So if you're locking in profits, these lines can be really, really valuable in setting the stage for where you're going to take a position off, as well as where you're going to put one on. All right, so if you're using the fib lines to keep you in a position, you can see that that 430.32 level definitely kept you in, and it also happens to be exactly the level of the anchored VWAP. And at this point now you're back to that full first expansion of the profitability on this thing. And we also see that the 2SD band on the bottom side of this thing has moved way far away. So it's a good illustration of how these fib lines come into play. Now let's look at some examples from the post-Fed day. And this again is Tesla. And you can see it opened and just really pushed higher. And when this kind of thing happens, there's a natural predisposition to get kind of oppositional and say you're going to look for the opportunity to short this because it's just moving higher too fast. So this was $430 per share, and it moved up to $436 in a matter of about 5 minutes. Problem with that is usually your gut is wrong. So your gut instinct will, generally speaking, get you a gut punch. And what you really have to do is be able to look at the trend. And this is why after the first hour of trading, I always walk away, because I think that it's too easy to get focused on what you were thinking before the open, what you were thinking last night, what you were thinking at the opening bell, and that'll get you in a bunch of trouble over the course of the day. So if you go clear your head after the first hour of trading and just come back at, usually I come back at about 11:30 Eastern time, right about now. And, then you can focus on what's happening in this latter part. And that's great, because now you're setting up a new set of bands. But how do you keep your head in the game early? I will tell you that it was very tempting when this bar right here pushed higher and then came back down and tried to close in the bottom of the range to just say, let's short this thing. And it's very similar to an infield fly pattern that I use quite a bit, except that, it got up off the bottom of the bar and it was part of this just sort of bigger trend push higher that got it above the VWAP. So you're looking at this and you're trying to figure out what is the game plan. And this is where you can use fib ratios as a way to just sort of get your head wrapped around what's actually going on. So if I go from today's open and I go up to that high, I'm just using the open because it's such a significant tick for the day. We could go down from the low and up to the high, and that would make this probably a 382 pullback instead of a 50%. But here you see it, it's a 50% pullback. And rather than looking to go short and violating the trend, what you can do here is look at the obvious thing that's happening. And if you go from yesterday's close and look at where we are right now, that's a really big push. So you're up from about $426. You're all the way up into $436. Overbought can stay overbought for a long time. And really, the focus here should be on, we've got something that's going to trigger a bunch of programs that like to buy this sort of price action. So when we get back into this 432.98 threshold, we've got the opportunity for a long setup, and that long setup then has a logical target at 436.04 and an extended target at 436.64. Then you can go out even further. Now you can look at the day and you get into this next opportunity. When the market starts tracking higher again, and it gets you all the way up into this next threshold, your fib ratio on the next swing tells you again, you've got a pullback that gets right in line with this VWAP. And that VWAP happens to be right here at the 618 retracement at 434.96. This is something I call a switch hitter setup in my work. And that entry, let me just delete these lines so we can see what's going on here. We talked about that live in the room, and that entry was at 436.04. on a violation of this high that we got you in. It never turned back, went straight up to our target at 437.67, and then our extended target that we talked about in the war room was 438.58. It had no problem picking that off, but look what happened when it did. It shot right back down into that pivot. So the retest of the high, we didn't take that off right away, we would wind up trailing it and getting out at 436.64, and then boom, there's the frustration as it goes, and it jacks right back up into that range, makes a new high, and then it starts what I call trading in the box. And this is the area that we're going to focus on for the rest of the session probably, is, what happens when it starts moving sideways in this box. At this point, I'm not using fib ratios very much at all. What I'm looking for is just, does the trend resume? Does the trend reverse? If we get a move lower, then we'll definitely swing back to our fib ratios and say, if we get down into here somewhere, and then we get a pullback, say up to the VWAP, is that a 50% retracement? Is that a 382 retracement? And then do we look for a continuation move lower? And the same thing goes for a move higher. If we pop up out of the range, I'll start looking for the fib retracements again, just try to find the logical inflection points that we can put on shares of either Tesla or TSLL. I hope you've enjoyed the presentation. I hope you decide to take the MTRI and sort of give yourself a little self-evaluation. I'd also like to offer you, you can join us live. You can get the trading plans and not join us live. I think it's always a good idea to pop into the room. Why wouldn't you? It's 2 weeks, as I said, are free, and you don't have to give us a credit card or anything. But with the volatility bands, you know by now what the idea is. You want to pinpoint just absolutely precise entries, identify the exact inflection points where momentum is likely to shift to your advantage. There's built-in risk management because you're using the volatility bands to define the stops. You're not guessing, if it gets beyond this thing, if it goes to the other side of the band, I shouldn't be in anymore, I'm going to get out. You can trade any market condition. This is about trending markets, consolidating markets. If markets are swinging wildly, just like they were in the Tesla example, you've got a game plan in place that's likely to get you from point A to point B. And between those two things, there's not going to be a bunch of stuff you're going to hate. You're going to know exactly what it is that you're doing. You're not guessing. You're turning volatility into a repeatable discipline strategy. And I've been working with these things for 30 years now. It's out there. We've had this stuff in front of people for so long. We've documented what it does. There's plenty of videos that show you exactly how these things play out. Everything that I've put in front of my guys, everything my guys receive every day is something that has been around a long, long time, and nothing about it has changed except for maybe the symbols. Volatility is going to create opportunity. You need to learn how to harness it. This is what this business is all about. Trading is about capturing the opportunities that are in volatility. It's TraderInsight.com/trade. That will get you right in front of all of this stuff. And as I said, I really hope you take us up on the offer, and we would love to see you in the room. Okay, so that's it for me for today. And I really hope, as I said, that you found this useful. If you have questions, you can just shoot me an email, adrian@TraderInsight.com, ADRIAN@TraderInsight.com. You can also shoot me a text, 310-804-2248. Just say, I'd like to talk about something. I'd like to talk about my trading. I'd like to talk about the MTRI. And I'll just shoot you back a text and tell you, what, I'll be taking a walk at such and such a time. I'm happy to hop on the phone and, talk to you while I'm walking and just sort of figure out whatever the situation may be. So let me know. And I hope you guys have just a great rest of the conference and a great rest of the presentations here, and that you learn a bunch about trading with Fibonacci levels and how to use it in your own trading business. All right. Have a great day.